Friends, thank you for being here today. What if I told you that the most reliable warning signal for a market crash isn't found in stock charts, but in the quiet exit of a single man? And what if I told you that man just walked away from the game entirely? A seismic event has quietly rattled the foundations of the investment world, a move that, for those who track the deepest currents of the market, carries the ominous weight of history. On November 10th, 2025, Michael Burry's celebrated hedge fund, Scion Asset Management, officially terminated its registration with the Securities and Exchange Commission. This was not a quiet retirement. It was a deliberate and profound statement. Under federal law, a fund is only required to maintain this registration if it manages assets exceeding $100 million. As of March 2025, Scion was comfortably above that threshold, reporting approximately $155 million in regulatory assets under management. The termination, therefore, was not a forced consequence of dwindling assets, but a conscious choice to exit the regulatory framework of public facing investment management. The rationale for this drastic move was delivered to his investors weeks earlier in a letter dated October 27th, 2025. The core message was chilling in its simplicity and clarity. Burry, a man renowned for his obsessive, granular analysis of market fundamentals, declared, "My estimation of value in securities is not now and has not been for some time in sync with markets." This single sentence serves as a devastating critique of the current financial landscape. It is the rational man's abdication from an irrational game. The investor who built his legend on finding value where no one else dared to look in the rotting heart of the subprime mortgage market is now stating unequivocally that value as a metric has become untethered from price. He is suggesting that the market is no longer just wrong. It has become fundamentally broken, driven by forces that defy the logic and mathematics that have governed finance for centuries. This decision is compounded by the strategy Burry is employing for his exit. Scion Asset Management is not merely liquidating, it is metamorphosing. Burry is converting the fund into a private family office. The implications of this structural change are profound. A family office is not subject to the same public reporting requirements as a registered hedge fund. Specifically, it is not required to file the quarterly 13 Farads report, the public document that reveals a fund's long positions to the world. This means that after the third quarter of 2025, the investment community will be blind to Burry's moves. He is, in effect, going dark. At the very moment market euphoria seems to be peaking, the man famous for spotting the apex of a bubble is shielding his strategy from public view, preparing for a storm in private. This is not the first time Burry has performed such a maneuver, and it is this historical precedent that gives his actions such terrifying gravity. This is only the second time in his career he has voluntarily shuttered a fund. The first time, famously, was in 2008. After correctly predicting the collapse of the subprime mortgage market and netting his investors and himself a colossal fortune, he closed his first fund, Scion Capital. He walked away from the ensuing chaos of the global financial crisis only to reemerge in 2013 with the new Scion Asset Management. That first closure was a punctuation mark at the end of a successful world changing thesis. This second closure, however, feels different. It is not an exit after the crash, it is a strategic retreat before one. It is a warning, an alarm bell being rung by the one man who was right when the entire global financial system was wrong. His actions today compel the market to ask a simple, terrifying question: what does he see now? What Michael Burry sees is a bubble of such historic proportions that it dwarfs even the mania he famously shorted in 2008. His final public filing, the 13 farads from the third quarter of 2025, serves as his last will and testament to the market, a roadmap of his apocalyptic forecast. The document reveals that Burry has staked a monumental portion of his fund on the collapse of the market's most beloved sector, artificial intelligence. His thesis is not a diversified bet against the economy. It is a sniper shot aimed directly at the heart of the AI revolution, targeting its two most prominent champions, Nvidia and Palantir. The scale of these positions is staggering, designed to capture headlines and illustrate the depth of his conviction. The filing showed Burry holding massive bearish positions in the form of put options against Palantir, the data analytics and AI software firm. He held puts with a notional value of $912 million. Against Nvidia, the undisputed king of AI hardware and the market's primary engine of growth, he held puts with a notional value of $186 million. These are bets that these companies, currently seen as the infallible architects of the future, are destined to crash. However, a critical clarification must be made, one that separates the headline from the mechanics of the trade. These massive figures, totaling well over $1 billion, represent the notional value of the options, meaning the total value of the underlying shares his contracts control. This is not the amount of cash he spent. The media often misrepresents this, but Burry's actual cost, the premium he paid to acquire these bearish positions, was a fraction of that sum. For the seemingly colossal $912 million Palantir position, his actual capital at risk was reported to be $9.2 million. While a much smaller number, this $9.2 million represents a total loss wager. It is cash he is willing to set on fire if his thesis is wrong, a testament to his confidence in their eventual demise. Even more telling than the size of the bet is its timeline. These are not short term trades intended to scalp a minor correction. The expiration dates on these put options extend far into the future, reportedly stretching into 2026 and even 2027. This detail is paramount. Burry is not betting on a quick, volatile dip. He is positioning himself for a prolonged, multi year collapse. He believes the AI bubble is not just a minor overvaluation, but a deep structural rot that will take years to unwind. This long term perspective reveals his core frustration. He is making a fundamental argument about a secular shift, while the market remains, as he noted, obsessed with quarterly earnings and daily price action. He is signaling that the correction, when it comes, will not be a correction at all, but a devastating, protracted winter for the entire technology sector. At the heart of Burry's multi year thesis is an accusation so profound it borders on heresy, that the entire AI boom is built not just on hype, but on a foundation of systemic, coordinated accounting fraud. He is arguing that the spectacular profits being reported by the market's biggest companies are an illusion, a magic trick performed on their balance sheets. His case is built on three pillars: a specific accounting manipulation, a circular flow of money that fakes growth and a dangerous historical parallel to the dot-com bubble. The first and most specific pillar is the accusation of depreciation fraud. Burry alleges that the hyperscalers, the tech giants like Meta, Google, Oracle, and Amazon, are artificially boosting their earnings through a subtle manipulation of their depreciation schedules. The mechanism is as follows. These companies are in the midst of an unprecedented capital expenditure, binge spending hundreds of billions of dollars to buy AI chips, primarily from Nvidia. This hardware has a notoriously short product cycle, estimated to be obsolete within 2 to 3 years. And yet, Burry points out, just as these companies are ramping up this spending, they are simultaneously extending the useful life of this very hardware on their books. Instead of depreciating these assets over the realistic 3 to 4 years, they are now spreading the cost over 5 to 6 years. The effect of this accounting change is immediate and profound. By understating their annual depreciation expenses, they are artificially inflating their net profits. It makes the companies look far more profitable than they actually are, justifying their astronomical stock prices. Burry has called this one of the more common frauds of the modern era. He has even quantified its impact, estimating that this practice alone will understate true depreciation expenses by a staggering $176 billion by the year 2028. He projects this will lead to a massive overstatement of earnings, 26.9% at Oracle and 20% at Meta, to name just two. This is not just creative accounting in Burry's view. It is a deliberate and systematic deception of shareholders. The second pillar of his accusation is that the growth itself is not organic, but an illusion, what he terms the AI money go round. He argues that the AI sector is a closed loop economy where money is simply passed from one tech giant to another, creating the appearance of explosive demand. He provides a clear example. Nvidia, the chip maker, invests $100 billion into OpenAI, the AI model builder, a move that helps boost OpenAI's private valuation. Then OpenAI, flush with cash, signs a massive $300 billion deal with Oracle for its cloud computing services, a deal that causes Oracle's stock to soar. Finally, Oracle, needing to build out its new capacity, places massive orders for chips from Nvidia, boosting Nvidia's valuation and completing the circle. Money has moved and valuations have skyrocketed, but is it real growth? Or is it just a handful of companies inflating each other's net worth in a circular feedback loop, a house of cards built on self dealing? This entire setup leads to Burry's third pillar, the terrifying parallels to the dot com bubble. The current capital expenditure spending on data centers has surged past $320 billion annually, a level of overinvestment eerily similar to the speculative mania that saw companies lay millions of miles of ultimately useless fiber optic cable in the late 1990s. That bubble was built on the promise of future demand that never materialized. Burry suggests the same is happening now. He points to data showing that cloud growth rates at Amazon, Google, and Microsoft are in fact slowing down. This suggests that real world demand is not keeping pace with the frenzied investment. This claim is bolstered by reports that OpenAI's own chief financial officer admitted to investors that user engagement on their platform had softened. The companies are building $1 trillion infrastructure for a revolution that may already be running out of steam. To understand why Burry is closing his fund, one must understand the sophisticated and deeply frustrating counter argument to his own thesis. The idea that he is simultaneously wrong now but right later. The market's current dynamics are creating a timing dilemma that makes his long term bearish position completely untenable in a fund structure that answers to impatient investors. The central flaw in Burry's immediate depreciation fraud claim is that in the current market, it is factually incorrect. His argument hinges on the idea that AI chips become obsolete quickly and should be expensed accordingly. However, the market is currently gripped by a historic supply and demand imbalance. There is so much demand for AI computation and so little supply of high end chips that old hardware is not losing value. On the contrary, its value is being sustained, if not increased. This is the plain analogy in action. In a normal market, a car or a plane loses value the moment you use it. But during the pandemic, used car prices skyrocketed because supply collapsed. The same is true for AI chips. Reports indicate that even 8-plus-year-old Google Tensor processing units are still running at 100% utilization. They are not obsolete, they are essential. Therefore, when a company like Google or Meta extends the useful life of this hardware on their books, it is not committing fraud. It is arguably making a perfectly justifiable accounting decision that reflects the economic reality of an asset that is not losing value. The ironic to Burry consequence is that these tech companies may actually be overstating their expenses, not understating them. If the chips are depreciating slower than even the new extended schedules, their profits are even stronger than what is being reported. This makes the stocks look even more attractive, drawing in more money and pushing prices higher, making Burry's short positions bleed cash day after day. This is where the depreciation bomb comes in. Burry's thesis is not wrong, it is just early. He is waiting for the inevitable inflection point when one of two things happens: AI demand collapses, or more likely, chip supply from Nvidia, AMD, Intel, and others finally floods the market and overtakes demand. The moment that happens, the value of all that old hardware will plummet to zero seemingly overnight. At that point, the companies will be forced to face a depreciation bomb, a cataclysmic accounting write down of billions of dollars in hardware that is suddenly worthless. This will vaporize their earnings and prove Burry correct. But this creates the timing dilemma that is forcing his hand. Burry is making a fundamental 2 to 3 year bet on this bomb. But his investors, watching the market obsessed with daily performance, see only losses. They see the S&P 500 hitting new highs and AI stocks soaring while Burry's fund stagnates or falls. They are unwilling to wait 2 or 3 years for a thesis to play out when they could be making money now. This is the classic investor's trap, perfectly summarized by the economist John Maynard Keynes. The market can remain irrational longer than you can remain solvent. Burry, a solvent genius, is being forced to fold his hand, not because he is wrong, but because he cannot afford to wait for the market to finally admit he is right. Burry's exit is not happening in a vacuum. It is set against a backdrop of increasingly fragile market signals and defensive, almost panicked reactions from the very CEOs he is betting against. When confronted with Burry's short thesis, the CEOs of these AI darlings are not responding with confident, data driven rebuttals about their valuations. They are responding with emotional, defensive, and evasive rhetoric. A prime example is Alex Karp, the CEO of Palantir. In response to questions about Burry's short, Karp did not address his company's astronomical valuation. Instead, he lashed out, calling the short egregious and framing it as an attack on America itself. He appealed directly to retail investors, wrapping his company in the flag, talking about supporting our warfighters and protecting the average person. This is a classic diversion. It's a populist appeal designed to sidestep the terrifyingly simple mathematical question: how is Palantir, a company trading at a price to earnings ratio of over 523 times, a justifiable investment? AP divided by E of over 500 means that at its current profit rate, it would take more than 5 centuries for the company to earn back its stock price. Such a valuation is not based on fundamentals, it is based on pure, unadulterated faith. This faith is being propped up by wildly unrealistic expectations for future growth. A recent JP Morgan report laid bare the absurdity of current AI valuations. The report calculated what it would take for the current massive investments in AI to generate a modest 10% return. The answer was a staggering $650 billion in new annual and perpetual revenue. To put that number in perspective, it is the equivalent of charging every single Netflix subscriber on earth an extra $180 per month forever. Or, alternatively, charging every single iPhone user an extra $34.72 every month forever. These numbers are not just ambitious, they are fantasies. They expose the fact that the prices of AI stocks are not pricing in a successful future, they are pricing in a mathematical impossibility. While the market chases this impossibility, the real economy is already starting to crack. The warning signs of a recession are flashing, even as the stock market, decoupled from reality, soars. For the first time since 1940, hiring in the professional and business services sector, the heart of the white collar economy, has turned negative year over year, without the economy already being in a declared recession. This has happened 10 times since the war. The previous 9 times were all during recessions. This suggests the downturn is not coming. It is already here, masked by the performance of a few tech stocks. This pain is being felt most acutely by the next generation. Youth unemployment, specifically for the 20 to 24-year-old demographic, has spiked to 9.2%. This is the highest level seen since 2016. These are the entry level workers, the college graduates who are being told they are entering the most exciting job market in history, only to find the doors are closed. The AI revolution, which promised to create a new era of prosperity, is in its current bubble phase already contributing to economic stagnation and locking a generation out of the workforce. This disconnect between a soaring stock market and a struggling real economy is the classic hallmark of a late stage bubble, and it is being driven by an unprecedented concentration of power. The market's health is no longer a reflection of the broad economy. It is an illusion created by a handful of mega corporations. We call them the Magnificent Seven: Microsoft, Apple, Nvidia, Google, Amazon, Meta, and Tesla. These 7 companies now account for a larger share of the S&P 500 than at any point in history, with a combined market capitalization larger than the entire economies of Japan, Germany, and the United Kingdom combined. This is not a broad market rally. It is a narrow, top heavy concentration that masks the weakness underneath. When the entire market is being held up by just seven stocks, the system's fragility is extreme. The fate of millions of retirement accounts rests not on the health of the economy, but on the quarterly earnings of Nvidia and the iPhone sales of Apple. This dangerous concentration was not an accident, it was engineered. It is the direct result of more than a decade of the Federal Reserve's easy money policies. The era of zero interest rate policy, or ZERP, and relentless quantitative easing flooded the system with trillions of dollars in artificial liquidity. This money had to find a home, and it did not flow into building factories or raising wages. It flowed directly into financial assets, inflating the biggest balance sheets the most. The Fed, in its attempt to stimulate the economy, instead created the greatest speculative bubble in human history. Now, as the Fed attempts to fight the inflation it unleashed by raising interest rates, it is the real economy, the small businesses, the home buyers, the white collar workers that is suffocating. The AI bubble, however, has become disconnected from this reality, a speculative entity feeding on its own momentum, impervious to the rising cost of capital that is crushing everyone else. This is the psychological tinderbox Burry sees. The public, having watched this bubble inflate for years, is gripped by an agonizing fear of missing out. They see neighbors getting rich on tech stocks and feel compelled to jump in regardless of price. This is the dot com mania reincarnated, but on a far grander scale. The narrative that this time is different has taken hold, with AI serving as the justification for any valuation, no matter how absurd. Investors are no longer buying earnings or fundamentals. They are buying a story, a lottery ticket on the future. A price to earnings ratio of over 500 for Palantir is not seen as a warning sign of insanity. It is rationalized as the price of admission for the next technological paradigm. This mass delusion becomes a systemic trap, ensnaring not just retail investors, but the largest financial institutions in the world. Pension funds, 401k managers, and index fund providers are now forced buyers. Their performance is judged against a benchmark, the S&P 500, that is completely dominated by these seven stocks. If a fund manager decides to be prudent, to sell Nvidia or Microsoft because they are objectively overvalued, they will immediately underperform their benchmark. Underperforming, even for the right reasons, gets them fired. This is the definition of career risk. It creates a catastrophic forced buying cascade where everyone knows the building is on fire, but they are paid to keep running back inside. This is the systemic no exit ramp fragility that Burry identified in 2008, and it is precisely what he is fleeing today. Michael Burry's decision to shut down Scion Asset Management should not be viewed as an isolated event or the idiosyncratic move of a disgruntled investor. It must be seen for what it is, the sounding of a historical alarm, one of the most reliable and terrifying crash indicators in financial history. The pattern is unambiguous. When legendary value investors, those who rely on mathematics, fundamentals, and balance sheets, publicly declare that a market has become irrational and walk away, a devastating collapse is imminent. It signals the final fatal stage of a bubble, the moment when smart money concedes that momentum and mania have completely replaced logic, and the only winning move is not to play This pattern is written in the bones of every major financial crisis. Look back to 1929. Jesse Livermore, the greatest trader of his era, watched the roaring 20s push stock prices to levels completely divorced from reality. While the public and the banks celebrated a new era of permanent prosperity, Livermore quietly closed all his long positions and began systematically shorting the artificial market. He was ridiculed, but when the market crashed, falling an astonishing 89%, Livermore walked away with a profit equivalent to 1.5 billion in today's dollars. Fast forward to March 2000. Julian Robertson, the founder of Tiger Management and one of the most revered investors of his generation, did the unthinkable. At the absolute peak of the dot-com mania, he shut down his fund. He wrote a letter to his investors stating that the tech craze bears no resemblance to rational investing and that he would not participate in it. The financial media called him a dinosaur, a relic who didn't get the new economy. 1 month later, the NASDAQ peaked and began a brutal 78% collapse that wiped out trillions in wealth and vindicated Robertson completely. And then there is Burry's first act. In 2008, he closed Scion Capital after his legendary bet against subprime mortgages had paid off. But while his own investors were still in revolt, they had tried to sue him, to force him to unwind his positions because he was losing money for years before the crash. He was called crazy, delusional, and incompetent by the very people he was about to make rich. His closure, then, was a sign that the system was broken. His closure now carries the same message. He is repeating the pattern. This is the second time in his career he has walked away. The asset is different in 2008. It was fraudulent housing debt. In 2025, it is fraudulent AI earnings, but the underlying mechanism is identical. It is a market built on easy money, mass speculation, and accounting practices that are at their core deceptive. The man who called the last great crash is telling the world that the math no longer works. The pattern is clear. Jesse Livermore in 1929, Julian Robertson in 2000, Michael Burry in 2008, and now Michael Burry in 2025. The smartest player on the board is walking away because he sees the checkmate coming. The only question that remains is who will be left holding the pieces when the game finally violently ends.